Hi guys, it's Mike here. Let's check out today's market. The US 10-year Treasury yield long-term interest rate rose sharply last night. This is a very important point to note. The market is not in response to this, and even negative on several points today. The Nasdaq in particular is down more than 1%, which is insanely important. Because if you don't get into the habit of thinking about the market based on these two performance indicators, the market will never get sweeter. Between these two, first is more important than the second. In other words, interest rates are much more important. There is only one law that you all need to understand. Market interest rates and stock valuations are on a seesaw relationship. When market interest rates go up, stocks go down. The only thing to keep in mind when watching interest rates, especially long-term interest rates, is that if they start to rise at a fast pace, it is a danger signal. Institutional investors use computer-programmed trading, and in many cases, they are set to automatically drop their stock positions when long-term interest rates rise sharply. In my tiny experience, a sudden rise in long-term interest rates for 3 days in a row is bad. Right now, the 10-year US Treasury yield is rising considerably. If it starts to rise at a faster pace from here, it will be quite dangerous. This one has been in a long-term downtrend from 1981, when it was over 15%. But this year, we broke out of this downtrend all the way to the top. Anyway, long-term interest rates are important. S&P 500 will not stop falling, and the price is approaching to the lowest price level from the beginning of the year. The chart below shows the early candlestick since 1988. Last year and the year before that, financial markets were very simple. On the contrary, the market this year is very difficult. Some times ago, I learned that in a bubble, the more stupid you are, the more money you'll make. Because the one who dances around with his hat switched off wins. So the presence or absence of literacy will be the deciding factor in winning. This one is also approaching its lowest price point since the beginning of the year, isn't it? Nasdaq. You should pay really good attention to whether it hits the second bottom since the beginning of the year or falls below that point. Of course, the market conditions are pretty bad. What I learned is that investors get caught in a bear market many times. They become more and more cautious. They hold onto some of their holdings, but they fall further, and finally, they dump their holdings. In other words, the more people are not positive and the more people are dumping their assets, the better the news. After that, it finally returns as the waiting selling pressure is gone and the stock price slowly gains royalty. The fear index is also at a low level of 27.35. Looking at today's sector performance, healthcare and communication services are the only sectors to close positive. All sectors have been hit hard this month. However, the sector that has been hit the least is healthcare. It is doing very well even in the current bad market environment. Here's the performance of the indexes since the beginning of the year. The S&P 500 has entered a bear market and it's down by 21%, and the Nasdaq is down nearly 30%. However, these still may not be the lowest point. There have been 6 recessions since 1970. The average drop was 39%. So, if we apply this average 39% drop, the lowest target would be 2,939.35. It's not surprising that the price could drop to this area. This is very important, so I will repeat it again and again. Which order is correct? The stock market decline followed by recession, or recession followed by stock market decline? The correct answer is that the stock market decline comes before the recession. The dot plot that has attracted my attention at this FOMC meeting is the expected distribution of the federal funds rate among Fed members in the Economic Outlook Summary. Here it is, and a tiny variation is particularly noteworthy. The forecasted value of the FF rate at the end of the 2022 is concentrated near 4.4%. The reason is that there is silent pressure from the Chairman Powell on each member. Indeed, most Fed members forecasting the FF rate for the 2022 around 4.4%. Everyone is reading the air and following the message the chairman wants to put forth. But what about the variation in the 2024 dot plot? There is a huge variation in 2024, with some members expecting 2.6% and others 4.6% or so. It's a ridiculously wide range, and there is no point in taking averages. In short, all Fed members are blind, and this is very important. In other words, no one can even imagine how dire the consequences of this tightening will be. The tremendous uncertainty is spreading before our eyes. At such times, we suddenly look to the side and see that we can simply deposit our money in the bank and receive 4% interest with no risk. I think that's a bit sad. Do you guys buy stocks now? You can't become a good trader unless you learn to move back and forth. Breaking news. An interesting article came out from the Wall Street Journal saying that gold is not an investment target. Gold is a bad investment. The ETFs linked to the price of gold have been falling for the past few months. The US truck freight rates are falling, which is also attracting a lot of attention on the ground. Container shipping freight rates are plummeting. FOMC meeting results show that the Fed caught up with market expectations, but future developments are unpredictable. At the FOMC meeting, as many expected, the US federal funds rate was raised by 0.75%. Thus, even though the FOMC meeting was in line with expectations, the result left investors wondering whether the outcome was reassuring or not, and left them with major questions about the future directions of the FOMC. The reason for this is that Chairman Powell emphasized the importance of the most recent economic data, especially the CPI. In simplistic terms, it became clear that the Fed would harden its stance even further if the CPI numbers were poor. Similarly, the Fed has an unusually strong job market. In particular, the number of job openings remains at a high level, which makes me nervous. High job openings suggest that wage inflation is likely to occur, and wage inflation is a peculiar thing. As such, we have been getting a glimpse of the Fed's desperate efforts to cool the job market, even at the expense of the economy. This FOMC meeting revealed that the Fed is tense about price statistics, especially wage inflation. Price statistics are difficult to predict. This means that the Fed's future actions are also unpredictable. That's why the stock market lost value, despite the 0.75 rate hike announced this time, and the contents of the dot plot being in line with market participants' expectations.